Hello, this is Jed Brewer with Study Groups and Below the Line Club. It's really nice to have you for the webinar today. We're going to be talking about fuel marketer tips and how to protect your balance sheet and streamline fleet fuel payments at the same time. So really pleased that we've got a few different speakers today. First off is going to be Corey Watson, who's the Vice President of Trade, Credit, and Business Insurance with Marsh, McLennan Agency. And then his colleague, Jeremy Sandusky, will be speaking as well, more on insurance tips and tricks. Corey really specializes in trade credit, or credit insurance is another term for it, and he'll be talking a little bit about how you protect your bottom line with trade credit, as well as microbonding. What is it, and is it a good solution for your business? And Jeremy will be talking a little bit more about some lines of coverages and trends that are taking place in there in the insurance side. And then following on that, we're pleased to have Johnny, who will be with us from Direct Fuel Sales. And Johnny Howard is the VP of Operations at Direct Fuel Sales. And Johnny's going to be speaking a little bit about unlocking synergies in this direct fuel sales ecosystem, and how your fleet can benefit from it, and how it can be used as a payment platform as well to ultimately drive increased business to your diesel gallons. So it should be an interesting webinar. We want it to be as educational as possible. We want to get your questions answered. So if you do have a question as we get going, please type those questions into the GoToWebinar dialog box. We'll be able to see those questions, and I can relay them on to the appropriate speaker at that time. So with that brief introduction, I'm going to turn the floor over to Corey Watson at Marsh McLennan Agency. And Corey, talk with us a little bit about how we can protect our balance sheet.
Thanks, Jed. I appreciate you having me on. I want to talk on the audience. We may have some folks that are familiar with traditional trade credit and or microbonding. So I want to talk about those two items, what the differences between them both, some options, and why fuel companies do buy this, or maybe why they should explore it to purchase that to protect the balance sheet. So if you'll look at on the next slide, Jed, you'll see this is a typical company balance sheet that shows roughly 40% of a company's assets are tied up in their accounts receivable. So you have a company that they don't think twice when insuring their land and buildings and trucks and equipment, but often these companies don't insure their AR, and their AR makes up such a big risk of their balance sheet. And I would argue that you're probably more likely to file a claim on your AR than you would the fire insurance of your building, but it's the most commonly uninsured asset. So we're going to talk about traditional trade credit and microbonding and how to protect that asset. So on the next slide, you'll talk about we'll look at trade credit. Next slide. Trade credit, for those of you that don't know, it is a typical insurance policy. You would purchase it, you invoice the customer. If the customer doesn't pay their bill, then you can file a claim. The carrier tries to collect it. If they can't collect it, they write you a check. So it's an insurance policy insuring your receivables. It's commonly been used in Europe for 140 years. It covers bankruptcies. These are formal or non-formal. Also, general slow payments, slow pay, no pay. I don't want to pay. I can't pay. I don't feel like paying. It covers all of that. The traditional carriers in the market that do this, from the cancelable side, Allianz, Coface, and Atradius are the biggest three. And then you have non-cancelable carriers. There's a difference in cancelable versus non-cancelable. Chubb, Liberty Mutual, AIG. So there are about 15 or 20 carriers in the market that do traditional trade credit.
And Corey, I know insurance markets in general have been fairly tight. Prices have been going up. There's been fewer carriers that are looking at the petroleum marketing industry. For example, I would say property and casualty insurance. Is that true with trade credit? Is it a really hard and tight market, or is it decently easy to get this kind of insurance should you want to purchase it?
Yeah, it's I'd say it's half and half. I mean, bankruptcies year to date today are higher than they were all of last year. So the forecast for the carriers are anticipating big losses in their portfolios in Q4 of this year and Q1 of next year. So is it easy to get? Everyone can most likely get a policy, but some of the limits are being harder to obtain. But the carriers underwrite to roughly a 40% loss ratio, so they're ready to pay claims. They just don't want severe claims that would make it preventative to take out a policy. If I answered that question right.
Yeah, that makes sense. Thank you.
On the next slide, you talk about policy structure options. We get all the time from fuel companies that say, do I have to insure all of my accounts, or can I pick and choose, or what if I just want one account? So, Jeff, you'll see from a policy structure side, they can be full portfolio, they can be only a segment. Most of the policies, they don't have deductibles. You can purchase a bankruptcy-only policy if it makes sense. Most policies are 12 months. You can go 24, sometimes a 36-month option for trade credit. And each policy is really specific to, is it lubes or is it fuel or what are the terms? So they're sort of structured around that. From a price perspective, I shouldn't have put this on the slide. I guess it's going to be tricky, but I would say that rates are determined by volume, by loss history, the quality of your buyers. Are they good or are they bad? They do an average portfolio risk rating, and then the terms: 7 days, 10-day terms, 30 or 60-day terms. All of that goes into pricing. But I would say what we're seeing here from our rate today is roughly a third of a penny per gallon, or 5 to 12 to 15 basis points on sales. So it's
how do you get into those various buckets, whether it's a percentage or basis points on sales versus a per gallon basis?
Yeah, so that's a good question. I think that's where traditional trade credit is normally priced on sales revenue. In microbonding, which I'll talk about here in a second, is priced on per gallon. So if you're a company and you only make so much per gallon, but the price of fuel goes up to $4.50, and now your revenue is higher, but you made the same profit margin, it's not really fair, because you're paying premium on higher sales than only because the price of commodity went higher. So on a per gallon basis is a better scenario for that company. On a sales-based company, it could be, let's say it's one company. I have longer terms and I sell to them 12 times a year. Sometimes that makes more sense.
Got it. Thank you.
So I think for those that know trade credit, it's a good option, but I'm really excited to share with you another option that's in the market right now. It's fairly new, and a lot of the folks probably haven't heard about it unless you're a purchaser of a microbond. So there's a company that has been in the market for close to 3 years. It's called Bondavol, and these guys have a microbond policy. Some of their clients you'll see there is Highland Fuels, BP, Shell, DAC Energy. They work with Exxon as well. So really large fuel companies. And what this allows them to do is they have a surety bond product in lieu of trade credit, which can be superior for certain companies than traditional trade credit. They have offices in London, Toronto, Copenhagen, and all of their policies are reinsured through Lloyd's, Arch, Vertebra, large reinsurance companies. So the next slide, we're going to talk about what's the differences between a microbond or traditional trade credit. And you'll see that trade credit typically pays 90% of a claim. The carrier has the right to cancel or cancel a limit during the middle of the policy if they think there's some problem with that buyer. It takes about 60 days to get paid. There's credit limit fees, and it can be true ups if the price of the commodity, like I said, goes up towards the end of the year. With a microbond, you have dollar per dollar claim payout. So $100,000 claim, they pay you $100,000 on that. It's non-cancelable, being that the carrier can't come in midterm and take that limit away. Claims are paid in 5 days in lieu of 60. There's no fees, there's no true-ups, and again, it's gallons-based pricing in lieu of sales. The downside of a microbond, it's very selective from a client's perspective. I mean, you're talking BP, Shell, Exxon, so they're not as easy to get. Jet, to your previous question, than traditional trade credit, and you have to have solid credit practices. And there's less monitoring, unlike trade credit that these carriers would monitor your buyers for signs of trouble. A microbond is sort of here's a policy, and it would be on your onus to monitor them.
So if I had a specific customer, let's just say it was a farmer, for instance, could I get a microbond on that customer? Do I have to do it across my whole customer base in order to get it?
Well, the microbond, if you're a company and you're selling propane to a farmer or something, you can get a microbond on that customer, correct. The trouble would be the fuel company qualifying to buy their own microbond. So like the fuel company doesn't have solid credit practices, and they don't have credit procedures, and they just sell to some farmers up in the northeast or northwest. The carrier may not want to issue them a microbond to the company, not necessarily to the farmer.
Got it. Yeah.
Because they're basically saying, they go to Exxon, they say, hey, we're not going to tell Exxon that how to do their credit procedures, right? We're going to trust Exxon to do their own credit procedures, and we're going to overlay it with a microbond. Trade credit says anybody can have it. We don't care about your credit procedures as much. We're going to insure your buyers. So they put more work on the buyer. Microbond puts more work on the policy holder.
That makes sense.
Yeah, and then we'll go to, I guess, the last slide. So sort of what are some of the reasons that, a company would buy a trade credit or a microbond in general? So, each company, has different reasons for purchasing these sort of balance sheet protection vehicles. But here are some of the reasons that companies buy it. Number one would be, could I increase the number of gallons sold if I had an insurance policy on the receivable? So oftentimes, because of the thin profit margins in this business, companies are hesitant to sell to companies because they can't take the risk of loss. So if we could come in and we could wrap that with some type of insurance vehicle, would they sell to that company, and could they make money, off the insurance policy? It also helps speed up the sales cycle. So sales brings the deal to credit department, and these insurance policies can approve limits in 10 minutes, at times, a day or two at most. So it's a very quick process to speed up the friction between the sales and credit department. There's also the monitoring aspect behind it. So it helps overlay your current credit department, reach out to you for signs of trouble. There's some value in that for certain companies. Another reason companies buy this stuff is for to borrow better from their bank, because with this type of insurance, you can pledge your receivables to your bank and get a 90% advance rate, eliminate concentrations in your borrowing base, eliminate letters of credit, reduce bad debt reserves. So there's a big financing tied to this if you're looking to get additional working capital. On top of that, if these companies are looking to purchase more from their supplier and they're being held down from their supplier on how much they could buy, we could actually insure their supplier. They could take out their own policy, and basically the fuel company could insure themselves and get longer terms, bigger limits from suppliers. if that's an issue down the road. We saw that a couple of years back with some other companies. No collection activity, attorney fees, credit reports. If you guys are doing that, this can save on time and money as far as that goes. And then lastly, obviously, it protects you in the event of a non-payment on your AR. So each company is different, right? So, some company may not even care about borrowing. They just want it for sales growth. Another company says we sell to anyone, but they take losses, so we want it for risk. Some companies want it to ease up tensions between sales and credit. So I think a conversation, is different for each company.
That makes sense, Corey. Well, we really appreciate that quick overview of both trade credit and microbonding. And again, we encourage any audience to ask questions. I can pick them up at the end if there's anything that you'd like to have Corey go into a little bit more. Jeremy, are you on the call? And Corey, I haven't been able to connect with Jeremy, so I don't know if he made it on or not. So what I'm going to do right now, Johnny, I'm going to flip over to you, and we'll pick up Jeremy at the end if he's able to get onto the call. So right now, I'm going to turn the floor over to Johnny Howard, and Johnny is with Direct Fuel Sales, and he's going to be talking a little bit about defining the direct fuel sales ecosystem, so how a unified payment platform can create seamless collaboration for merchants, fleets, and aggregators, and also how your fleet can benefit from a customizable application programming interface, which is a big word, but an API, application programming interface for fuel payments. So really diving into fuel payments a little bit more, and Johnny, I really appreciate you telling us a bit about direct fuel sales and how we as petroleum marketers might be able to benefit.
Yeah, sounds good. Can you see my screen okay?
I can.
Perfect. Well, yeah, good afternoon, everyone, and welcome to our informative presentation on DFS, fueling success and unlocking synergies within the DFS ecosystem. Thanks for being here, and special thanks to Study Groups and Jed for putting this on. Today, I'm going to really focus on diving deep into the world of digital payments, understanding what the DFS ecosystem is, and how it can optimize payments for drivers and merchants alike. So just getting into a little bit of an introduction of DFS and also kind of what we're seeing in the market today. DFS was created because the truck stop payments industry has been dominated by a few key players. Namely, WEX and FleetCor have been some of the biggest players within the industry within the last 20 or so years. And with that, the fees for independent merchants have really gone up to a point to where it's really hard to compete at the level that they would like to. And especially this year, we've noticed that there's been some demand shrinkage within the drivers for freight on the road. And at the same time, diesel prices have actually increased through especially Q2 and Q3 of this year. So it's kind of a interesting dynamic that we have going on where diesel prices are going up, the demand of drivers are actually going down within the industry. So with that, merchant spread has decreased, and it's been harder to offer rates that are affordable to drivers, especially owner-operators and smaller fleets that they're looking for to really lower their overhead. So our goal has been to increase competitiveness in the market and also raise the bar in terms of service expectations while lowering transaction costs for everyone involved. And this allows truck stops to be a little bit more competitive and set prices more freely. So getting into the DFS ecosystem, what we do is we digitally market merchants to drivers, enabling drivers to reserve fuel seamlessly through a code or a digital coupon, if you will. This new approach fosters a streamlined process at truck stops, which enhances efficiency for both drivers and merchants alike. As we witness the changing dynamics of the industry that I mentioned before, DFS aims to help businesses navigate those challenges. Our platform goes beyond mere payment processing. It also serves as a comprehensive solution for both individual owner-operators and potentially also large fleets. So DFS connects with over 300 merchants nationwide, and we continue to grow to about 20 to 30 new locations each month. And really what sets it apart is not just its wide-reaching network, but also its ability to adapt. And that's kind of where we get into a little bit more of the API, which I'll touch on in a bit. So our platform offers customizable interface, empowering channel partners, which would be what we would call our fleet partners, to integrate with. And they can tailor their interactions precisely according to their unique requirements. So the customization extends to creating branded user experience, aligning seamlessly with the identity of whichever business we're partnering with. And right now we've really focused on, as we rolled this out, a little bit more of the companies within the tech side of the driver industry, just because it's a little bit of an easier integration with our API. But what we're starting to do is roll this out more and more to different users within the market. So which would include anybody from a large fleet to a company that maybe is fleet with company drivers that use a plastic card, but they also have a lease division where they're trying to get those owner operators better pricing, more akin to whatever their drivers are getting, their company drivers. So in this slide, I just want to quickly touch base on how the transaction process works. This has been similar. We kind of adapted to what's already been out in the industry for a little while now. Essentially what happens is the driver can reserve fuel digitally, and they can do that on their phone or website. It really depends whatever our channel partner wants to use. And they receive a code in return. When the driver arrives at the truck stop, the cashier can just authorize that code via the DFS tablet, and then DFS then processes the payment to the truck stop. This type of transaction is essentially just like a coupon authorization process. So just where that driver authorizes that coupon on their phone, and then our tablet or our kiosk can authorize the payment through to the truck stop. So Mudflap has had a similar payment system to this in terms of tablets and the counter. The biggest difference between us and them is our really where our technology lies, which is our API. So getting into the API, an API, or as Jed mentioned, it's an application programming interface, is just a set of rules and protocols that allows different software applications to communicate and interact with each other. So it defines the methods and data formats applications can use to request and exchange information back and forth. So, for example, in this context, our APIs serve as a digital bridge, or bridges, if you will, enabling seamless communication between various elements within the DFS ecosystem. So they allow for fleet management systems, digital aggregators, driving apps, and merchants to connect with DFS's proprietary closed-loop payment system. So through APIs, these entities can request fuel transactions, receive payment data, and integrate DFS services directly into their own software platforms. The usefulness of APIs for this context really lies in their ability to streamline operations. So by integrating with DFS, businesses can automate fuel payment processes, eliminate manual tasks, reduce errors, and it really enhances efficiency, and it can accelerate transactions. We can get reporting, live reporting because of the API, and it's all digital code based. So we can see current redemptions that are happening, or current transactions that are happening, and you don't have to wait till the end of the day to look through and start reconciling your reports, or the end of the week. You can see all that data real time. So really does enable both fleets and merchants to focus on their core operations. And then DFS can really, and the API and the automation can really handle the complexities of the fuel payments, and it kind of results in a more agile, responsive, and profitable operation with that as well. Currently, there's quite a few big names inside of the tech industry. So as I mentioned, we've focused our initial integrations with some of the largest names in tech related to over-the-road truck drivers. So we refer to these companies, as I mentioned, as our channel partners. So on this slide here, you've got TruckSmarter, Trucker Path, and Relay Payments. We also work with Cloud Trucks and Exo Freight currently. There's 2 other channel partners that are working on getting plugged into our API, both kind of in that similar tech and service companies. But each of these companies are already exist and are usually focused on different things. Like, for example, TruckSmarter is a freight factoring and load board application. Trucker Path is a fuel finder, and then Relay Payments is a lot of things in the world of payments, including fuel, obviously, and then also parking and payments for lumpers. So we've got a pretty broad network, and it reaches out to over 40% of the U.S. driver market today. Use these applications in various ways. So some of them are not always using it for just the fuel price, but they're on those applications, and it allows merchants to be broadcasted and advertised in front of those drivers and have a little bit higher of a chance of getting fuel that way. And this kind of gets into all of the other people we can work with. So on the slide, you see we can plug into fleets, aggregators, tech services. We offer a seamless integration. So for any entity with drivers who utilize commercial diesel lanes for fueling, they can plug into our API. And so, as I kind of mentioned, the market is uniquely poised where there's a lot of drivers that are looking for a way to lower their overhead, streamline their payment processes, and also be able to have access to where they're fueling quickly using tech or an existing application. So it's a good opportunity for a fleet that either is small enough and they would like to upgrade their fuel payments to a digital application to plug into DFS, or if it's a large fleet that has a owner-operator division or lease division for their trailers. It's also a great opportunity if they're looking to extend some of the pricing they get for their company drivers to those other drivers. DFS is a quick way to get plugged into, especially if the fleet is already underwriting any of those drivers for credit. So that's an option where they can just plug in an ACH to DFS, and then we can distribute those payments out to the truck stop or truck stops. We can quickly do that. And then we also have the option where drivers can actually plug in their existing payment methods. So if a fleet or a tech company is looking to offer fuel services to their drivers, they can just plug in their credit cards, and then that can go through and or debit cards or whatever payment method that's quickly available to them, and then they can get access to the DFS network as well. Obviously, in those cases, the merchant fees have to come out of the discount because if they're using a Visa or MasterCard, the channel partner would have to incur that additional fee and mark up the diesel price accordingly. So kind of getting into some of the economics and advantages for this. So one of the biggest things for the fleet or for the drivers is there's cost savings. So no driver transaction fees. They can just fill up and move on with their day. They don't have to worry about any incurring fees with that. And then also enhanced cash flow. So DFS settles with their channel partners weekly. Generally, this is a lot of channel partners have to settle with different fuel card companies on a daily or biweekly basis, so we can really increase cash flow that way. And then we also have our DFS, what we'd call discount network, that I kind of alluded to on the previous slide, where a lot of the merchants that we sign up onto the DFS, they opt into the DFS network and offer some kind of a discount. So this is especially great if a company is just getting into this and they're from the tech-based side of things and they're not really super familiar with fuel. They can just plug into the DFS discount network as well as the API, and they can get those pre-negotiated discounts with those merchants and offer those straight to their drivers. And then the operational efficiency is also a big deal here. So DFS allows channel partners to create their own user interface, their own UI, if you will, and branding package. So we're also aware that some service and tech companies, as I mentioned, may not be super familiar with all the nuances of the diesel market. So along with the API and the DFS discount network, we have an in-house team of consultants that can make integration pretty simple to hit the ground running. We also have a network of about 300 locations, as I mentioned, and we're continuing to grow that rapidly by about 20 to 30 locations per month. So again, it's great because, you know, if you have your own brand identity, you can essentially offer this fuel payments method on your application, or if you don't have an app but you're a browser-based company, you can offer it on your website as well and start doing transactions through DFS, or your drivers can start doing transactions through DFS. It's all under your own UI and your own brand.
When you
and kind of getting, go ahead.
Are those like companies that you're working with, or are those 300 like diesel sites?
Those are 300 sites. They're split across several companies at the moment. But yeah, they're all 300 individual locations at this point.
Got it.
Yep.
And then your work, you can be anywhere in the nation and be a part of this, your network. Is that right? You don't have to be in a specific state or region.
Yeah, no, we go all over the states, so there's no specificity on location necessarily or region. So as a merchant, you can get plugged in anywhere and get going on the DFS platform.
Makes sense. Thank you.
Yeah, you're welcome. So kind of getting into that with the merchants, that's really what one of the biggest things we're able to offer in addition to that API to channel partners is the merchant network. So our relationship with the merchants is really what's really important to us and sets us apart from other folks in the industry today as well. And that's where we're hoping to keep everything aligned with is our servicing to the merchants. That way it enables a smoother transaction for the channel partners, for the drivers and everybody else. So for the merchants economics, we offer a 2 cent per gallon transaction fee, which is actually the lowest in the industry today. And then additionally, DFS can help grow gallons through market exposure. As I mentioned, we've got over 40% of the driver network plugs into DFS in one shape or another. And there's a lot of discount options as well. So as I mentioned, you can sign up in the DFS discount network and automatically get plugged into all those drivers and offer them any additional pricing you'd like to. And importantly, we are able to provide a very simple system for cashiers to interact with, which really minimizes the errors on the counter. And you don't have to have individual tabs or individual kiosks to run the different transactions with our channel partners. It's all under one screen. Really easy to use code reservation system just to authorize those coupons, if you will, authorize those codes. And then, due to the nature of digital payments, we can actually provide real-time reporting. So merchants can see codes that have been recently redeemed and ones that have been reserved the reporting is really clear and consolidates all the transactions onto one report, which makes it really easy for account receivables to reconcile and understand what's going on. And that being said, if there are any issues with disputes, we have really hassle-free dispute resolution. We can usually get to the bottom of anything that does go on within 24 hours if there's any disputes with the driver or with a code or reservation. So that being said, Jed, do I have time to run through a quick demo on our reporting software?
Yeah, go ahead.
Perfect. So it's a pretty basic system. And for this case, this demo truck stop has 2 locations. So from the dashboard, you're able to see what your retail prices are and also see the gallons that you have per day, which will include your current day as well. And you can go back to the beginning of time with this and see what April looks like and so on and so forth. You can also see redemptions, which would be all the transactions that you've recently redeemed, and that'll go up to, again, real-time transactions. So you can see what's going on at your location that day and see how many gallons are coming in. And in addition to that, you can see the reservations. So these would be transactions that haven't been redeemed at the site yet, but they're coupons that drivers have started. So that way you get a good idea of what's coming into the location and get an idea of preparation for gallons and things like that. Reporting, we've got settlements. You can access these and you can download these as CSVs. And these all have all the data that you would be looking for, including transaction ID, reserve date and time, payment date and time, the exact amount of gallons sold. And then if you're offering DFS some kind of a discount, like in this case, it looks like it's 29 cents per gallon, you can see that and what the DFS rate would be along with the transaction fee. And what's really great about this, the daily summaries are similar, but what's great about these is if you do have 20, 30 locations, you can see that in one report as well and see that for a merchant summary. And that'll include all of the different truck stops or fuel stops that you have. And then lastly, our pricing. You can edit the retail prices across all the locations at once. And then you can edit the controls at the kiosk level. So if you're worried about the cashiers entering in the wrong retail price, you can allow them to edit that at the site, or you can take that privilege away. And then you can even access the tablet in real time and remote into the tablet through this button here. So it's a pretty basic system, not a whole lot going on, but it's that's kind of the beauty in it all. It's clear and simple. So just in summary, DFS is a trusted name amongst fuel stop operators and stands poised to offer drivers a reliable way to lower their overhead, get rid of plastic. It optimizes their business in general. So it's a great opportunity for anyone within fleet technology or with just drivers on the road in general to optimize their payments for their users and lower their overhead. I think there's a huge demand in the industry for that today, and will probably continue to grow for fleets and drivers in various different levels. So yeah, with that, thank you. Appreciate it.
And Johnny, I'm just curious, your view on where the industry is going. I mean, it feels like more and more diesel is sold through some kind of back system, like what you're doing, as opposed to just shows up at the pump and pays with the credit card. Where do you anticipate it kind of going in the years ahead?
Yeah, I would anticipate that to just kind of continue. I think especially for diesel operators, for truck stops and fuel stops, there's a much smaller market than there is for gas station operators in general. So I think there's a little bit less innovation going on within the industry on the tech side of things. And I think we're starting to see a little bit more of that change and a little bit more competitiveness as it goes to or relates to diesel transactions. So I would anticipate, especially within the payments industry, things to kind of continue to evolve and move that way, especially with the demand shrinkage that we're seeing in, since 2021, 2022, there's a lot of diesel being sold and a lot of good margins all around, but we're kind of seeing that start to go away a little bit. So I think folks on both the driver side and the merchant side will be looking for other solutions to be able to, save on their bottom line.
That makes a lot of sense. Well, thank you so much, Johnny. Really appreciate you giving that update on DFS and some of the trends that you're seeing out there. Jeremy, I'm curious, did you make it onto the call? We were going to have you share a little bit about some trends in insurance markets, pollution, auto, property insurance.
Yes, Jed, can you hear me?
All right. Hey, Jeremy, glad you were able to make it on.
Sorry. Had some technical difficulties. I apologize.
I'm glad you were able to make it.
No, I appreciate you having me on.
And I'll try to pull up, I believe I've got your slide deck on here. We'll just grab it real quick and I'll run it from my computer.
Perfect. Thank you, sir.
All right, dive right in the 15 minutes that we have.
Perfect. So I'll make it fast because no one really wants to talk about commercial auto insurance these days. It's a quick introduction about Marsh McLennan. Corey told a little bit about us, but we are the largest agency in the U.S. Where our actually parent company is Marsh Corporate. Corey and I are locally in the DFW area. We have 13 regional offices, but that was just a quick, something about us. But yeah, the state of the auto insurance market, and since it affects so many people on this call, it's crazy. The attorneys and the litigation has just gotten out of control. Travelers released a report yesterday that 70% of your auto premiums now are going to attorneys. Just a huge number. It's crazy. It seems like anytime one of our clients just bumps a private passenger vehicle, they're getting sued. We're picking up a lawsuit for them. The cost of vehicles these days is out of hand. Our client totaled out the brand new Escalade the other day. I didn't realize that was $155,000 unit. Anytime you've got a bumper on a Toyota Corolla now that's $3,000. The front lights are $1,800 each. So just the cost of vehicles, anytime there's an accident. These nuclear verdicts have gotten out of hand where a jury of your quote unquote peers are handing out 80 million, 120 million, 250 million. Is just insane where, you've probably seen them all across the U.S. We also call it, social inflation. It's sad. It's such a large number. And, at this point, the insurance carrier would rather settle than even, remotely make it to court. So, and then, something we all talk about is distracted driving. We're killing 8 or 9 Americans a day, over 1,000 accidents a day from people texting and driving. So when you kind of add all these factors together, it's creating like a perfect storm. So something, risk management and claims tools that, our clients ask, well, hey, how do we get our, auto premiums down, or, what can we do to help? So, we're trying to look at things outside the box because, 10, 11, 12 years ago, we had all these insurance carriers that we could go to that would write commercial auto. Now, we're down to, in some markets, one carrier. Another market, they only have 2 or 3. And and that's, that's affecting pricing. One of the carriers we work with, they know they're the only game in town, so they can continue to, ask for rate year after year after year, which is very frustrating. And some alternative risk strategies that our clients have had to look at is, going into a captive, and not being at the mercy of the standard commercial insurance market. They're gathering together with other similar risks. They are essentially becoming the insurance carrier and sharing in the underwriting profits. That's been something a lot of our clients have started to go, looking at hard, and some of them have started rolling into. Some of them have started, going to higher deductibles just to help out with, with the pricing. We're seeing incredible things with DriveCam. I would say, 6-7 years ago, maybe 30-40% of our fleets had it. Now today, I'd say, 75-80% have it. And if you don't, I would highly, highly recommend looking into it, because it is such a great claims management tool for your insurance carrier. I see them every day where I was like, if we didn't have that video footage, 10 out of 10 times traditional insurance carrier would have paid on that claim. And then something we provide also, and I know there's also third parties, but DOT consultants to help you, make sure you manage your files correctly. Data queue, when you do get a citation, if you can dispute it. So just there's quite a few things, that you can look at other than what I would call the traditional insurance carrier route.
On the cameras, it just feels like it's something you got to do these days, to your point, Jeremy. And the number of study group members I've seen in meetings who've been able to prove themselves innocent, because otherwise you're guilty until proven innocent, sadly, in today's world. And it just saved many times over whatever the cost of the implementation of the cameras are.
Oh, yes, I agree. And and I had a client, he has fought me for, or fought against having cameras for, 5 years. And he put them in 6 months ago, and he has had 2 major claims that were not his fault, that we had video evidence. The plaintiff immediately hired an attorney, and in both cases, we sent the attorney the video, and he dropped both cases. And I thought this was kind of suiting for the panel, below the line. What we always say is, above the waterline is your premium. And, that wasn't what sank the Titanic. It was below the waterline. So, all the things below, uncovered claims, insufficient limits, coverage gaps, job location shutdowns, lost time of key personnel. So, so we look at total cost of risk, just not your insurance, quote unquote, premium that you're paying. So it's, we try to do a deep dive into, everything that it's costing you. So that's just kind of I love that slide, and I thought it fit well for the group.
Absolutely.
But yes, today we are in what's called, an unconventionally hard insurance market. It's tough. It is, and it's tough for our clients, and, it's something we're trying to think outside the box, and possibly, looking ahead at, all right, what does a captive look like? What is a captive? We have our own captive programs that are exclusive for MMA that we've been able to help our transportation clients go into. And so it's, you gotta take action quickly, because, it's these insurance carriers are, they're losing their shorts right now on commercial auto, and they're wanting rate. And, if your agent isn't getting out ahead of it and telling you, hey, it's going up, they're really not doing you a service. I received a phone call from a gentleman yesterday in Houston, and his insurance premiums last year were $1.7 million, and his agent showed up a day before renewal, and nothing changed. His fleet stayed the same, his exposure stayed the same, and his premium went to $2.8 million. It went up $1.1 million without a warning, and he's like, I don't know if I'm going to be able to keep the doors open. So we're going to try to help him out, but just make sure you're not caught on your heels. Make sure you're communicating with your agent. They're getting out way ahead of it for you, and that's the best way I would say to take action.
It's been interesting, Jeremy. In my 20 years in the industry, insurance has gone from a line on the P&L expense line to a very critical expense line, one of the largest, outside of labor, that's on a petroleum marketer's P&L. Do you see, as you look out into the future, any softening of the market? Do you anticipate it to continue to harden? I understand it's a little bit like trying to predict the stock market. None of us know, but what's your best guess for what the future looks like for the market?
Yeah, great question. So right now what we're seeing is, it still continues to go up, even on clean accounts. I just renewed a client the other day that I would call it was a clean risk, and what the insurance companies are wanting is quote unquote inflation. So, 7-8% if you have, if you are clean. If you have some losses, they're still wanting double digit increases, anywhere from, I'd say, 15 to 24%. And then if you're a tougher risk, they're just completely bailing. To predict the market, if we do have a slowdown, what a lot of people are predicting next year, I wonder if we are going to see maybe a little bit of the soft market, kind of, these underwriters are like, hey, we're losing premium, we've got to put some more on the books. But I think they're trying to put on, more exposures like general liability, work comp, things where it's just auto. It just seems it's the temperature is so hot on it right now. I just don't see it going down. And it's unfortunate, and that's the great thing about us is we're a broker, not an agent. We work for, our clients. We don't work for the insurance company. So the great thing is we're constantly going to bat for our clients, trying to beat up on the insurance carriers as much as we can. But I don't see any immediate relief in the market. So I'm afraid, everyone's going to continue to see increases.
Yeah, that makes sense. It's kind of my feeling as well, just with the litigious nature of our society and these nuclear verdicts that you referenced, and just the continued distracted driving and accidents that are out there, maybe until we get driverless vehicles or something like that.
And something we learned through this process is some of these large law firms are not as large as they appear. What they do is they run what they call sweeps every week in major metropolitan cities, Dallas, Houston, Austin, Oklahoma City, Chicago. And what the attorneys do is they'll run a sweep of when a commercial vehicle hit a private passenger vehicle, and there was a police report filled out on it. They send all that information to India. India puts together a form letter with the attorney's name at the top and then mails it to the person that was hit. And so they're like, hey, you know what? We can get you $1 million. Just call us. We understand you were hit by, XYZ trucking this last week. Let's get you, policy limits. So there's a lot of that. So it's sad. And, like you said, it's such a litigious society we've become.
Yeah. Well, Jeremy, I really appreciate that high-level overview of where you see the state of particularly the auto industry and the need for alternative solutions, whether those are captives to explore or high-deductible plans. but even putting in safety measures like cameras, et cetera, to reduce our risk overall. It's a big issue for all of us out in the petroleum marketing space. And for the audience, just want to say thank you for being on the call here today. We'll send out the slides that were presented on the call, as well as a recording of this. If you want to view it again or share it with a colleague, you'll have access to be able to do that. Also, I know any of our three presenters, if you have any follow-up questions, would be more than happy to take any of those questions. We'll be sending out their contact information as well to you, so you can go ahead and take action on that if you want. Look forward to seeing you again on a future Below the Line Club webinar. Hope you found this to be an educational use of your time, and enjoy the fall that's upon us. Have a good day.